adjust over time, but I think trying to get into that with lawmakers would be kind of inappropriate given our independence and our need to stick to our name.
Yeah, you can keep positive. What an answer. He's right. Well, you know what he said?
Hey, what's up, guys? Sam here, kicking off the noon session for Thursday, June 22nd, 2023. Good to see you. Thank you, Mirza. All right, so we're going to be covering market internals today. It's going to be a really good session for you to ask any questions because, it's one of those things where I don't know what you don't know kind of thing. So as we go along, ask any questions. And if we don't get any questions, it should be a relatively breezy session. So we're going to be covering market internals today. And there's a couple different ones you can look at, of course. My favorite one is going to be the advanced decline and the tick. I also will typically have something like a VIX product. You can have the VIX, although the VIX isn't really all that great. You can have the VIX futures. You can have VXX. Something that tracks volatility, I think, is generally helpful. So just kind of using these three as my market internals with a special focus on the advanced decline as well as the ticks. And on the ticks, the way to think about the ticks is think of them as kind of a sprinter. So you can call them kind of your market heartbeat if that works. But the ticks are basically going to be looking at how many stocks are making an up move at that exact moment in time versus how many stocks are ticking down. So the ticks, you want to see them usually above or below 600, right? Anything between 600, which has been basically all of today, is just noise, right? This is all kind of meaningless in this box. It gets a little bit more meaningful once you get below 600 or above 600. And obviously the closer you get to 1,000, the stronger that is. So when you have a strong tick reading, and let's say that you are up here at 1,000, that means that there's 1,000 more stocks ticking higher than there are stocks ticking lower. So that can come in a lot of different ways. You can have 1,500 stocks ticking higher, and you can have 500 stocks ticking lower, right? And that would end up with a positive 1,000, which would be a really strong reading. The reason you care about the ticks is because it shows usually algorithmic or program buying. So it takes a lot of money and energy to get the ticks up there or down here. And when you see that, that's usually a sign that there's a program running in the background that's either buying or selling. And you ideally want to be on the right side of that. So the main thing here with the ticks, just to wrap it up, between 600 and 600, just noise. I wouldn't overly complicate this. Above 600 is where it becomes a little bit more important. And what you want to see is not necessarily just a spike higher. You want to see it kind of just, up here around this plus 600, plus 700 area, right? That's actually the strongest signal that you can get. Very oftentimes you'll get these kind of rogue ticks, way down here, or as I speak right there. But generally speaking, you want to see them be maintained. So I'd rather actually have something like a consistent 700 tick than a one-time 1,200 tick, right? I think that's actually a little bit more sustainable. So that's the ticks. The advanced decline, similar idea. Similar idea, except the advanced decline, whereas the ticks would be kind of a sprinter, meaning that you have to kind of get off the starting line to start with, right? So you have to sprint, and then the advanced decline is a little bit more like the marathon runner. So you can see how if you combine the ideas there between those two, you end up with a pretty good view of the market. With the advanced decline, I normally like to see a value below 1,000 or above 1,000, right? I find anything in between is kind of just noise. And then again, you can always use a 0 line as kind of a resistance level or a support level. So let's say that today, this thing did happen to go up here to 0, that would be a resistance level. Or, on another day, if it was up here above 0 and it comes down to 0, you'll often find support there as well. With the advanced decline, it's a very similar idea to the ticks, except the tick is looking at this exact moment in time right now. Like right now, as we speak, there's 800 stocks, or I guess now 600 stocks, ticking lower than higher in this exact very moment. With the advanced decline, it's looking at the total of stocks that are green minus the stocks that are red, right? So right now, this is telling you that as we speak, there's 1,150 stocks more that are green than red. And so it's entirely possible. And again, you can just figure the math. You can have 1,000 stocks that are green, but then if you have 2,150 that are red, you'll end up with a negative rating, right? So the way that usually works, just so you can actually apply this and make sense of it, is usually the ticks get the party started, right? Think of the ticks as kind of your match or your ignition. So once the ticks get the party started, like in this case, let's say that something's getting started here with a negative 800 tick, then it has to then play out in the advanced decline. And when you start to see these two moving together, that's actually your strongest possible signal. Now, one thing that comes up a lot, and this is really, really important, something that comes up a lot is like today, for example, this morning, you had like the NASDAQ did that. But the advanced decline was below 1,000 and basically not great all day, right? So how did that happen? Remember that the advanced decline is looking at all the stocks equally. However, the NASDAQ, specifically the NASDAQ, has stocks that weigh much more than a regular stock. So one Apple is worth 2,000 IWM, right? So in this paradigm that we're in, where you have such market dominance at the top of the market with Apple, Amazon, Google, Tesla, Nvidia, things like that, just pushing up those stocks hard enough will overwhelm the need for the advanced decline to be up this much. So if you pull up Amazon, Amazon's up what 4% or something. Apple was up almost 2%. Those two stocks alone are worth more than these 1,100 that are red, right? So on a day where you have the advanced decline negative, check the mega cap tech stocks. And if you happen to see a lot of energy there, then that will explain what is going on under the surface. All right, so that's basically it. That is basically it. If you have any questions, let me know. I don't know what you don't know. But if you have any questions, do let me know. There are several advanced decline. Why use the advanced decline over the others? The only other one that I would consider using, and I certainly think there's a lot of value to this one, is the ADUSD. Now, the ADUSD, it's important to understand what it is, right? So the ADD that I showed you initially, that one is the advanced and declining stocks for the NYSE. The ADUSD is looking at the NYSE, the NASDAQ, as well as the Amex. No one cares about the Amex, but it is looking at that. The cool thing about the ADUSD versus the ADD is that you get that NASDAQ look. Now, there's also an advanced decline just for the NASDAQ, right? So here's the thing. You could look at the advanced decline just for the NASDAQ individually. You could look at the advanced decline just for the NYSE individually. Or if you want to group them all together, which I think makes sense, the ADUSD is probably your best bet for that. So is there a right answer? The right answer is just what makes you the most comfortable. I would say that the ADUSD is the most comprehensive one, but just because I'm so familiar with the advanced decline, I just continue to use that. But I could probably certainly justify using the ADUSD. Do I ever look at vol difference? Not really. No, not really. I think I find a lot of that is going to be reflected here in the advanced decline. The vol difference is basically the same thing. It's up volume versus down volume. And here's the thing, that's also looking at just the total volume. So for example, based on my understanding of it, if you have like a stock that really matters, like Apple, and then you have some junk stock that doesn't matter, like Peloton, and let's say Apple trades positive 100 shares and Peloton trades negative 200 shares. Well, what would your reading be? 100 minus 200. It would be negative 100, right? And that would color the market in such a way. But in reality, Peloton ticking down 200 and Apple ticking up 100, those two things are not the same, right? Apple ticking up 100, just in volume, just using an arbitrary number, is worth way more than Peloton ticking down 200. So while I can, I wouldn't push back if you decided to use Vol D. It's just not something that I resonate with. I think you can accomplish everything you need to really accomplish just with the advanced decline of the ticks. So just remember this. Like, this is probably just like the center point of the conversation. The ticks have to get the party started. It always starts with the ticks. If you're going to have a raging fire, it will then happen with the advanced decline, right? So if you're going to get like, let's say that this thing wanted to go up here to 800. So or let's just hypothetically say the market wants to reverse from this exact spot, which it probably will. The ticks would go up to 800 first, and then you would start to see the advanced decline do the thing. If you see the ticks go up to 800 and you do not see any reaction in the advanced decline, you should not trust that. So ticks get the party started, advanced decline finishes the job. When trend draws, green line and red line are moving in opposite directions, what does it mean? Well, it means you should look for something better that's aligned. I don't want to get into that because we're not necessarily talking about that, but generally speaking, if the trend oscillator, green line, and the red line are not doing the same thing, and there's maybe no space between them, then you have to use your high-low. You'll know it when you see it. I mean, I don't want to get too deep into this, but like if we look at something like Meta, this is what you want to see, right? You see the alignment here? Right there. That's what you want to see. Green on top of red, both moving in the same direction. If you see anything that doesn't look like that, if it's just kind of like this, then you then have to rely on the lower indicator. VWAP, can we talk about implications for daily price breaks above it? For example, just slipped under VWAP. What do we expect? Well, VWAP's, I don't know if I call VWAP an internal necessarily, but it is a very important thing to know and to track. The simple answer on VWAP is just think of it like a very important intraday support level. So if you're trading above VWAP, normally that will act as a support level. If you're trading below VWAP, normally it will act as a dynamic resistance level. Now, it can flip back and forth, certainly. But yeah, I mean, if you're trading under VWAP, it's usually a bearish thing. If you're trading above VWAP, it's usually a bullish thing. What's the ADSPD? I think this one's just looking at the, this is the advanced decline, but it's looking at just the S&P 500. So these are all basically just different shades of the same thing. So ADD is the NYSE, which has most of the S&P 500 stocks in it. ADSPD is just the S&P 500. ADUSD is all of them. So these are all just basically shades of the same thing. I would just try to really understand one, and then you can use whatever you like. But as long as you understand, like if you understand ADD, which is what we've been covering, all the rest of these are the same thing, basically. It's just a matter of how comprehensive do you want to get into it. Is tick and toss the same thing as tick and trading view? I'm not entirely sure. I don't use trading view for intraday, so I can't answer that. And Uno Musk question, your favorite internals trade, vol USD and ADUSD persist upward when price taps lower VWAP extension. Yeah, for sure. I mean, that's, you know, if you want to get really, like, we could probably close with that. That's actually a really strong signal. So one really strong signal you'll see, for example, and I'm just going to do it hypothetically because we don't actually have that type of price action right now. But let's say this is the S&P. We'll just say SPY. And the SPY goes lower, comes up, makes a lower low, and then comes up a little bit, right? So you kind of have this crooked W thing with the low there and then a lower low. But then if you look at the advanced decline, and the advanced decline goes lower, it goes up, it comes back down and makes a higher low. See so price basically would go lower, advanced decline higher. This is actually one of the strongest signals you can have. So from a internals point of view, if you can spot those divergences, those are really, really strong signals. So S&P would look like that. ADD would look like this. If you happen to see this, that's a really, really strong signal. And the same thing is true to the top side. So for example, if SPY looks like this, goes up, makes a peak, comes down, makes a higher peak, then comes down a little bit, and advanced decline does that, makes a peak, goes up, makes a lower peak, that's a negative divergence. That's a really strong, this is advanced at this point, but that's a really strong signal. The only thing I'll add here, because I don't see any other questions, consider adding the 21 EMA to a 5-minute advanced decline and the 200. I find that to be really, really helpful. So it's the 21 EMA and the 200 on a 5-minute chart. Do I use intraday P call? No, not really. I like it using, like you mentioned, the looking at it daily and then seeing where the 10-day moving average is on the P call. I don't use it intraday. I don't find it overly helpful. Your mileage may vary, but I personally don't use it intraday. It's a good idea to know where it is. And certainly it's an even better idea to know where it is based on its 10-day moving average. But I don't use it intraday. All right, guys. Last call for any questions, if there are any. If not, I got to get back to the old trading thing. Do you time entries or exits based on internals? Not really. Like for example, if you were looking to get long here, one thing that you would want to see that would really help the case for the long would be a break of this resistance level on the advanced decline. So you see how the advanced decline has kind of this little resistance level there at negative 1,000. If the advanced decline could get above that, then you could really start to get something. That would actually probably trigger a long. What would really trigger a long would be if it gets above the opening gap high of the day, right? So you could treat the internals the same way as you would price, right? So there's basically a resistance level there. If you go above that, it's going to trigger a long in the market. And then if you were to get above the secondary level, that would really trigger a massive squeeze into the close. You don't have it yet, but that's what I would look for. And then the same thing goes in reverse, right? Like if you were to break here, and especially here, that would trigger a short. This would trigger a big short. So that's the way I use them. Is VIX compression partially due to 0 DTE? I would say so. I would say it's pretty strongly related to that, because the VIX is looking 30 days out. So it's not picking up any of that activity, given the prevalence of the 0 DTE stuff. There's a lot of weird stuff going on in VIX at the moment, but I definitely agree that the 0 days focus on is skewing it a little bit. The good thing is though, like they do have a new VIX for that, so you can actually track the VIX 1D, and the VIX 1D actually will track the will track the 0 day stuff. So this is a new product that just came out. It doesn't really work the way that I would expect it to work, so I don't necessarily use it myself, but just be aware that that is out there. The VIX 1D will track the 0 day stuff. HYG, I wouldn't necessarily consider HYG as an internal, but yeah, I like where your head's at. I certainly wouldn't mind. You know, if you said that you use HYG as an internal, you and I probably would get along, because that's actually a really high level thing to do. I want to just kind of focus on the basic stuff here, because I don't know exactly where everyone's skill level is. But yes, if you look at HYG, it's the same thing. With HYG, if the market's green, you typically want to see HYG also cooperating, right? One thing that you don't want to see with HYG would be the market green, HYG deep red. That would be a warning signal. But yeah, HYG is a pretty decent internal, or decent way to track the market, I would say. And then last question, how is this related to a rate hike? I don't know what that means. Nothing that we've discussed so far has anything to do with rates. I didn't see any follow-up on that. All right, well, that's most of it, guys. So if there's anything you think I didn't cover, shoot me an email or let Mirza or somebody know, and we'll come back and we'll cover it again. But really, the main thing I wanted to stress to you guys was just the interplay here between the advanced decline and the tick, and not just from like a commodified point of view, like, oh well, you know, this is what it does, you know, in a way that you can actually use it in your trading, right? Because it's like, yeah, you can go just read Investopedia and read what these do, but it's important to also understand the way that the interplay between these two basically drives the stock market day to day. So that's that was the focus. All right, guys, that's my time. Thanks for being here. Have a great Thursday. Cheers.